Good afternoon, traders and investors. Will back here with another one, coming to you with a weekly market recap. Hope all of you had a nice week of trading and are starting a very beautiful weekend as well. Now, in terms of this week's past price action, guys, it was an absolutely wild week. It was a week of everything in the kitchen sink. We had so many different economic data points that came out. We also had so many earnings, especially from big tech. And now I'm happy to say, guys, that we are kind of halfway through most of the volatility. A lot more volatility could arise over the course of this next week because we also have a fairly big earnings week, and we also have two very large macro and economic data points, which will of course be the results of the presidential election that we'll get on Tuesday morning. And thereafter, of course, we have Jerome Powell coming out with an interest rate decision on the Thursday session. So in today's video, guys, we're going to do a few things together. Number one, we're going to recap a few data points that came in on the Friday session, right? Number one, the unemployment rate, the non-farm payrolls, and a little bit of ISM manufacturing. So we'll do that in the first part of the video. Thereafter, we're going to go through three earnings releases rather, that I have prepared for you guys. And those are going to be ones that we did not have time to cover throughout the week. I'll be choosing SOFI, PayPal, and McDonald's for the topics of today. So that'll be part number two. Thereafter, we're going to do our major technical analysis rundown of our major stock market indexes, followed by our big tech names. And after such a wild week, see where everything stands and if there's possibly some nice buying opportunities to be had in the markets after we've had this slight little correction. And in the end, guys, we're going to do a full portfolio recap, the trades made this week, the wins, the losses, and which positions I am carrying into the next week of trading. It's been a very good week for myself and our Discord members, so looking forward to showing you guys the gains. Now, moving into the video, guys. So first things first, the SPY up about 0.42%, the QQQ on Friday up about 0.74%. But as you can see, the SPY gave a lot of the move intraday back, and even the QQQs, they did give about half of the move to the upside back. Just goes to show that the bears are still in somewhat of a short-term control right now. Taking a look at the heat map, you will see that although it was a fairly broad market session, you did still have some pain points, utilities, real estate, and energy, to say the least. Big tech was doing good, nice little recovery after the Microsoft and Meta negatively received earnings, because I thought their earnings were quite good. But on the Friday session, you can see Apple still down after their earnings, Google and Meta, Amazon, the big winner after their earnings, Microsoft, NVIDIA, semiconductors coming back a little bit, financials having a good day too. So as you can see, guys, very, very, very mixed market, but I liked to see healthcare coming back. We really need that sector to start participating to uphold some of the SPY. On the one-day relative, you can see what a mixed market it was, led to the upside by consumer cyclical, healthcare, technology, and industrials, to the downside, utilities, real estate, and energy. Unfortunately, where does that leave us on the one-week relative? Well, you can see it was a down week for the S&P and the QQQs, only communication services making it out alive to the positive territory. Everything else to the downside, weighed heavily by technology because of those big tech earnings that, for the most part, were very, very good numbers, but the market just didn't receive them that way, and we were net down on the week. So before we get into more technical analysis, guys, let us jump into a few of the macro points that we got last Friday, right? So taking a look here, number one, I'll be covering the non-farm payrolls. As you can see, the expectation was for 113,000 jobs to be added, and we only added 12,000. Is it time to panic right now? Is the jobs market fully falling apart? Actually, no. So these were a couple things that we'll get into in it shortly, but you'll see the unemployment rate is actually staying stable at 4.1%. So let's go over a few of those reasons why the jobs were so weak. So let's have a look here, guys. Well, a lot of it had to do with the hurricanes and the effect of some strikes. So take a look at this, guys. You can see the non-farm payrolls. This is the 3-month average, and it has been steadily declining from the peaks we had in 2021. So the jobs market is weakening, which is a natural byproduct of interest rates being maintained very, very high for arguably the last year and a half. We are expecting this, but the one thing we want to focus on is, are jobs falling off an absolute cliff? Is the unemployment rate skyrocketing? And as of right now, the answer is no. So the Federal Reserve is still trying to thread the needle for the Goldilocks soft landing scenario. Will they get it? Well, only a few more months of data should provide the absolute answer to that. But as of right now, even though there's some small red flags, everything does still appear to be somewhat healthy. So here we go. We knew strikes were going to subtract 44,000 jobs from the total, but we were somewhat in the dark on the hurricane hit. Now, the Bureau of Labor and Statistics and essentially for this for the jobs numbers, right? We're also saying that there was possibly between 40 and 50,000 jobs that were not added as a byproduct of the hurricanes. So between the strikes that we saw here, a lot of them in the manufacturing, 33,000 to Boeing alone. A lot of that was due to the strikes and also the, of course, results of the hurricanes. The total of the two is anywhere between 90 and 100,000 jobs. So there is your miss, guys. Quite simply, right? There is the miss on the non-farm payrolls, 90 to 100,000 jobs, most of which are hurricane or strikes related. So we have to take this result with a little bit of a grain of salt, right? One report is not going to derive a long-standing trend of large misses. The last miss that we had that was very important was in August, of course, which led to a bit of a market sell-off. But overall, the market reacting quite positively to this one, despite the big bad number, right? If that number was not due to strikes or the hurricane, the markets would have been totally red on the Friday session, but the market's kind of filtering through the noise right there and giving a somewhat positive outlook because we know as well this week coming up, the Fed is going to have a 0.25 interest rate cut. The probabilities of that now stand at about 99%. So the Fed will still be cutting interest rates over the course of the week. So that's everything for the non-farm payrolls. I wish I could provide more clarity, guys. But in terms of the rolling average, you saw the average coming down over time, but we are not yet falling off an absolute cliff. So we'll keep a watch on the jobs numbers that are going to come out later this month of November and December as well. I really don't think all in all that we'll have a good picture of whether or not the recession is coming for the economy much before January and February, right? We're going to need to see these Q3 earnings from all of these companies, or rather Q4 earnings at that point in time. And we're going to need to follow these data points very, very closely. But as a whole, guys, right now, inflation seems to be under control. The jobs market, although weakening ever so slightly, also doesn't point any massive red flags. And on a third stance right there, well, we just got the GDP numbers on Wednesday, and the economic output activity does still seem to be relatively healthy right there at about 2.8% growth in Q3, right? So not that bad on the economic front, guys. We're through most of the data points. The big economic data points for next week, of course, are going to be the presidential election and then the Federal Reserve interest rate decision here on the Thursday session. So we'll keep a very close watch on those two things. Now, let's jump into some juicy earnings, shall we? So we're going to start it off, guys, with PayPal. So PayPal coming in with their earnings Tuesday before the market open. And let's take a look at the numbers, because since the earnings happened, well, PayPal is down roughly about 7.5%. So were the numbers that bad? Well, the short answer is no. However, PayPal is still in a transition phase right now, and I wouldn't necessarily say that they're back to the growth that we experienced in the business in 2020 and 2021. Take a look at the numbers right here. They did beat on the bottom line EPS by about 12%, but they missed on revenue, 0.52. And arguably, guys, this revenue number is a lot more important because we've been worried about PayPal's revenue growth. They've always been able to maintain relatively stable margins and stable free cash flow all throughout the drop, right? That was never the concern. The concern was, is PayPal still a growing company? And that is measured through revenue growth. So let's take a look at the article right here, and then I'll give you guys my thoughts on the matter. So PayPal shares fall on revenue miss and soft guidance. Let's look into it. There's some negative points, but there's also some very positive points that the new CEO is pushing for. For the fourth quarter, PayPal is calling for low single-digit growth. Analysts were expecting growth of 5.4%. So low single-digit growth, guys, think about 3, 4, 5%. So that is under the estimate. Not the best metric for PayPal right now. The company expects adjusted EPS of between $1.07 to $1.11, and the estimate was about $1.10. So maintaining profitability, but the revenue growth is really the pain point right now. Revenue increased about 6% in the quarter. PayPal reported net income of $1.01 billion. This is about a 12.9% net profit margin, which is relatively in line with what PayPal's been showing recently. Here's the profit margins as a whole. And you can see that over the last roughly 5-6 quarters, they have been between roughly, let's call it 12 and 14. So not much change there, but it's nice to see that they're protecting their net margins, even though the revenue numbers are slightly dwindling, as we can see. Now, the new CEO, Alex Chriss, has focused on prioritizing profitable growth and better monetizing key acquisitions like Braintree. which is used by Meta for credit card processing, and payments app Venmo. The total payment volume rose by 9%, which is very decent, right? They are funneling in more total payment volume. And this has really been one of the best things that PayPal has been able to maintain as of recently is this increase in TPV, right? That's the one thing you do not want to go down is the total payment volume or the number of customers on the platform as well. But those two metrics did come in quite good. The company's operating margin was 18.8%, beating the street account estimate of 17.4. Once again, operating margins of 18.4 above last quarter and pretty much higher than they've been in roughly the last 10 years. So PayPal is navigating the landscape quite well in terms of protecting net margins, which was done by Alex Chriss, the new CEO. He really tried to focus on cost control and improving margins, and so far so good. PayPal reported total active accounts of 432 million, up 1% from a year earlier, and beating the estimate of 430.5. So the total active accounts is going up, but not that much. But however, you do not want to see TPV or total accounts go down. So as of right now, at least PayPal's business is still growing. One of Chris's strategies to address the deteriorating margin was to offer merchants increased value-added services, such as connecting a couple of data points at checkout to drive down the rate of cart abandonment. This is a very big thing that all of the major players tried to combat, from websites like Amazon to other retailers, right? Abandoned carts is the number one thing that they try to have higher conversions on. That product, dubbed Fastlane, is a one-click payment option for online sales that can go head-to-head with Apple Pay and Shop Pay by Shopify. So what they're trying to do, guys, is usually when people add items to their cart, there's a net drop-off in conversions if once you go to the cart, you have to add in your credit card details. Sometimes people, you guys know how people are, right? They just don't have the patience to go get their wallet, go get their credit card number and type it in if it's not saved in their browser. So sometimes they just abandon the cart. So what PayPal is trying to do is kind of like Apple Pay or Shopify Pay, is they're trying to add a PayPal button to just be able to check out. You don't have to fill anything in. It takes your details and it makes the checkout process a lot smoother, right? So this service called Fastlane targets the 60% of online payments that aren't using a branded payment option, in the hope that a customer will graduate from a guest checkout and convert to becoming a PayPal user. The other big product launch during the quarter was PayPal Everywhere, which went live in early September. The initiative offers 5% cashback for using a PayPal debit card within the mobile app. Thus far, PayPal has seen 1 million new PayPal debit card enrollments. Very, very nice for the new service. All of this is driving back branded checkout growth, said the CEO. Venmo's total payment volume rose 8% in the quarter from a year earlier. This is very good. They're relying heavily on Venmo, and its popularity seems to be increasing. They have partnerships with DoorDash, Starbucks, and Ticketmaster too. In the short term, Alex Chriss says the two primary monetization levers are the Venmo debit card, which allows customers to spend with their balance both online and offline, and Pay with Venmo, which provides a seamless way for customers to pay online. With these product improvements in place, we are now leaning into marketing for Venmo for the first time in years. So although PayPal's total processed volume is not going up significantly, although their active customers is not going up significantly, you can see that the new CEO is targeting the pain point areas of the business that have kind of been left in the dark for the last 2-3 years under the former CEO and under former management. He's doing very nice things to try and heighten conversion for online brands, and he's also attacking at expanding Venmo's business as well, which is a very big business for them. So I like this earnings report for PayPal. They are still in a transitional phase for their business, but at least they are moving in the right direction, guys. And one other thing that they've been doing recently is buybacks. Look at the shares outstanding. You can see that at least in the last 2 years, they've really started going hard on the buybacks, buying back roughly 10% of their stock over the last 2 years. So always nice to see this too. Just goes to show that they're using those improvements in operating margins, improvements in free cash flow to start to return a lot of that money back to the shareholders, right? Trying to drive shareholder value and trying to drive appreciation on the stock as a byproduct. Now, where do we stand in the grand scheme of things for PayPal right now with their problems, with their resolutions to those problems as well? So let's have a look at the business, guys. In terms of free cash flow, let's look at the financials. So as you can see right here, PayPal does have a lot of debt, but they do manage that debt fairly well, right? They have about $13.5 billion of debt. They have half of that in cash on the balance sheet, and they do have a decent free cash flow yield, which we'll get into. It's about 9.1%, which is fantastic. So the balance sheet is not looking the worst. It is quite okay in my estimate. Moving on, in terms of EPS growth, we can see that transition year. EPS has not moved, guys, since 2021, but should be expanding in 2025 and onwards. So this has been the major concern for PayPal. They have not been growing on EPS, and as a whole as well, the revenue gains are just not that substantial too. They are gaining on revenue, but not as fast as you'd like to see a tech company growing revenue, right? They're only growing revenue at 6.5% per year. That is a little bit slow in my humble opinion. So the pain points for PayPal do remain on that front. Now, revenue growth of 6.5%, EPS growth of 11% per year, driving home those net margins, gives them a valuation as follows. At $77, their PE ratio is a 16.8. Seems a little bit cheap, but we divide that by their EPS growth rate, and we get the PEG ratio of 1.53. Anything under 1 is good, anything over 2 is high. So 1.53, it is just okay, guys. I wouldn't say that PayPal is the deal of the century. As a matter of fact, in my opinion, the most cheaply valued fintech play right now is Square. Square does a lot of what PayPal does, but they do even more. As I've labeled it right here, they do what all three of these companies do. Square is a 3-in-1 solution. They have the PayPal Cash App platform, right? Competing with PayPal's Venmo, Square has Cash App. They also have a solution like Affirm where they offer buy now, pay later. And they also have a solution like SOFI where Square offers banking, trading, and loans. So that's why my favorite play in fintech right now is Square. They're a 3-in-1 package deal. And look at this valuation, guys. Look at the PEG ratio down there. 0.6, so much cheaper than PayPal on a relative comparison valuation basis. But if you want to keep to PayPal right now, I wouldn't be opposed, guys, since we do have the weekly and monthly uptrends, right? This one, for a long-term portfolio play, probably not for me. I think I'm better off sticking with a lot of big tech because big tech has either the same or cheaper valuations when you just look at Google or you look at Meta and things like that. There's better deals to be had in the market right now. But if we're looking for a little bit of a swing trade, the bulls do have the monthly uptrend, and we do have also the weekly uptrend as well. So there may be a nice little trade to be had here, right? Weekly uptrend, back test of the previous resistance, which is now support, 74 down to 72. I would not mind taking a little bit of a swing trade here on PayPal because we can see that although the company is struggling a little bit, most of the analyst price targets are either at the midpoint at 90 or closer to that $100 mark. So I do think PayPal has some room to grow. But as I said, not my favorite fintech play as of right now. So that's everything for PayPal. So let's just close a couple of these. And now we're going to get into company number 2, which is going to be SOFI. So SOFI, another fan favorite, another retail favorite as well, right? So moving into SOFI, SOFI actually had some quite good earnings. They dropped a very large amount after their earnings, but they were able to recapture a lot of that because I think the market realized that it had kind of made a mistake because SOFI earnings were actually very, very good. Take a look at the numbers right here. 23% beat on EPS. That is fantastic. And a nice 9% beat on revenue. So SOFI, very fantastic double beat by a wide margin. But SOFI stock tumbles. Its earnings report was otherwise solid. Let's look into it. So SOFI notched its 4th straight quarter of profitability. That has been one of the main concerns about SOFI in the last few years. You can see right here on a yearly basis, 2019 through 2023, the company was net margin negative. And now in the last 4 quarters, as you can see, they have flipped the script. They are now net margin positive. So that's exactly what everybody wanted to see. And they are also positive on an EPS basis as well. So turning the corner to profitability in those 2 very important metrics. Let's move on. Total deposits grew to $24.4 billion in the quarter. This is very, very good. SOFI added more than 756,000 new customers, has now nearly 9.4 million customers. So still relatively small in the whole banking space, but they are expanding quite nicely. SOFI began as a lender focused on refinancing debt. It now operates as 3 segments: lending, which includes student, personal, and home loans, financial services, and a technology platform. So they're really expanding their offerings, guys, offering debit card solutions, credit card solutions. They're also offering stock trading and crypto trading solutions as well. So they're broadening their horizons. I love to see when a company does this. Moving on further, our financial services and tech platform segments now make up a record 49% of adjusted revenue, up from 39% a year ago. diversifying the holdings and the offerings of the business. Origination volume for loans within the lending segment rose 23% from a year ago, with personal, student, and home loans up 26%, 3%, and 38% respectively. Very nice, rounding the cyclical bottom of the reduced demand for loans. Now, it expects adjusted net revenue between 2.5 and 2.55 billion for the year, and earnings per share of about 11 and 12 cents. That is above. So the guidance here, guys, that is above the analyst consensus for revenue of 2.46 and above the analyst consensus for EPS of 10 cents. So not only did they have a double beat this quarter, but they beat and raised for the next quarter. So triple beat for SOFI. Now, looking ahead, guys, in recent quarters, the CEO deemed 2024 a transition year. Looking ahead, he says he sees sunny skies. Listen to this. 2025 is the first year in which we don't see headwinds. We see a declining rate environment, we see a stable economy, and that's going to bode well for our businesses. And for the first time, we'll have the wind at our back as opposed to a headwind. So looking very good for SOFI, guys. It's true. They IPO'd kind of in a very tumultuous period of time, right? They IPO'd early 2021, then they got a tremendous rally in 2021 because stocks were going crazy. And then when you had peak interest rates coming up, supply chain concerns, inflation, all that stuff, they got absolutely destroyed. So now it's true what the CEO has said, right? They're rounding the corner. They are now a profitable business. And for the business to become profitable in an unfavorable macroeconomic environment is quite good. So now the CEO sees sunny skies ahead. We'll see if they're able to maintain this momentum. Taking a look, guys, new member additions. Look at this. Very nice member growth right there. Products. So the amount of products that they have, a lot of these are stocks, of course, but they continuously add new products to what clients can have. These are the Galileo accounts. So this is part of the technology platform. This is essentially, so SOFI provides now a back end for a lot of major banks. Their largest player is one of the European banks as well. So essentially what this means is, so in terms of the Galileo accounts, right? So Galileo is somewhat of it's a back-end platform for financial services transaction processing. So whenever you make a transaction through a bank, whether it's, cash movement from checking to savings or in a brokerage for brokerage transactions, buying and selling of stocks, Galileo is kind of the operating system that does all that behind the scenes, right? You can think of it kind of like as a Windows operating system, but for banking transactions. So it's been a very hot product. And as you can see across the various financial institutions that are using the Galileo backend, we are now up to 160 million accounts that are being worked on that are being utilized by the backend service, right? So very, very good. Lending and financial services products, those are both up as well. So nothing more to see than this. This is the last slide I'm going to show you guys. Financial services and tech. So tech is the Galileo. Financial services is their diversification away from loans, right? So talking about their credit card offerings, talking about their stock and crypto brokerage platform, right? So you can see that these two things together are representing a larger and larger proportion of the business. These two are in light blue, and the traditional loan business is in the dark blue, right? So very nice. We have diversification of the business, kind of putting away some of that concentration towards the loan business, which is exactly kind of what we want to see, right? So looking very good in terms of SOFI on those two fronts. No problem at all. The quality of their loans has also improved quite a little bit right there, and they really don't have any major risk of default right now. They have a lot of cash that they can possibly deal with if anything were to arise on those fronts, right? So in terms of the earnings, guys, so that's, we went through it very, very quickly. I could spend 20, 30 minutes doing a deep dive on SOFI, but that's not the point, right? We just want to know, is the business doing better than they were last year? And are they moving forward on a nice basis in terms of margin expansion and EPS expansion? And the answer for those two questions is yes. So as we can see, guys, EPS expansion in the future is very nice, going positive, and revenue expansion continues to ramp at a very healthy pace. Now, let's take a look at their valuation. So at $11 where they are right now, they have a revenue run rate of 13% growth per year and an EPS growth of 51% per year. Now, this may seem like a very high number, but keep in mind, we're coming from zero, right? So these are penny increments. So it's normal that the EPS is rising in a very rapid fashion. You're going to expect this to taper off as the business matures, of course, but As a whole, the PE ratio at $11 is a 4 on a forward basis, 91.6. You might see this at a first glance and say, wow, that's expensive. But don't forget, it's a relative basis. They're growing EPS at 51% per year. So that's why we use this, divide it by this, and we get a PEG ratio. This is what allows us to compare different companies with different growth rates and different PE ratios on a common basis. And we can compare SOFI with PayPal, with Microsoft, with Google, with McDonald's, with tons of other ones, right? So, PEG ratio of 1.8. Now that's a little bit high, not over 2 though, but it is a little bit high. Obviously down here was a very good deal, and I was playing a lot of SOFI down in the $7, $8 range. Up here, it's getting a little bit rich. Not too much though, and a price to sales is only about a 4.76, which is also not terrible for the company, right? So all in all, the valuation is a little bit high, but I wouldn't say it's crazy high right now. For me personally, though, I'd be kind of partial to be waiting for a little bit of a pullback in the event that the SPY and the QQQ continue pulling back for XYZ reason, and we can maybe revisit, let's say, the lower 9s. I would be tempted to take somewhat of a breakout retest trade around that $9 level. They closed a beautiful, beautiful, beautiful monthly candle, guys. So all in all, if we do pull back a little bit, I will be buying the dip, but I'd like to see 950 or better to start averaging into a position, or just for some swing trades as a whole. Chasing it up here is usually not the type of strategy that I like to do. Even though they are performing well, I'm always looking for those dip buying opportunities because we're now a little bit extended on the weekly RSI as well. So just watch for the pullback. If we come back down 950 to 9, you'll probably see me play a lot more SOFI specifically. And now our last earnings trade that we have to discuss, guys, is McDonald's. So McDonald's coming out with their earnings, and they unfortunately had a little bit of a drop after earnings, coming down after that by about 2-3%. Now, we know this company has been dealing with E. coli headlines as well, so those will not be in the earnings numbers much before next quarter, right? The outbreak of E. coli came after their Q4, or their Q3 rather, had ended. So you won't see the results of the E. coli impact on sales. Even though the company said it wouldn't affect sales that much, we won't see that until next quarter. So let's take a look at the numbers real quick. They did beat on EPS by 0.78%, and they beat on revenue by about 0.81% as well. So small beats for McDonald's, but a beat nonetheless. McDonald's reverses U.S. same-store sales declines in the third quarter, but E. coli fallout looms. Now let's move in. Investors are worried about another dent to U.S. sales fueled by a recent E. coli outbreak across 13 states linked to the Quarter Pounder burgers. As of Friday, 75 cases have been tied to the outbreak, including one death of an older adult. Daily sales and traffic turned negative immediately after McDonald's was linked to the outbreak. Still, the company isn't expecting the situation to have a material impact on its business. Health authorities have honed in on the burger's slivered onions as the likely source, and McDonald's has suspended its relationship with the supplier. All in all, they appear to have the situation in control as of right now, but we know they had to get it under control quickly, guys, because headlines like these can really be detrimental for a brand. Chipotle went through this several years ago, and it took them months and months to recover from just the impact on the brand image, right? So, moving on in, McDonald's posted third quarter net income of $2.26 billion. In terms of profit margins, 32.9% net profit margins, guys. McDonald's has really never had a problem with net margins. You can see that the business has very, very, very high net margins, not only because of production efficiencies, but also just because of the overall franchise model, right? So they collect a lot of royalties, to say the least, and McDonald's as the chain itself, right, doesn't necessarily own, doesn't pay for the locations itself. They're paid for by franchisees. So a lot of these net profit margins are just because of the business model they run. You can see in the last 5 quarters, they always run in the mid to low 30% range, and that has been the case as well for the last 3 years. So net margins on par, nothing to see there. Net sales rose 3% as well. The chain's global same-store sales, however, fell 1.5%, a more drastic decline than the 0.6% that Wall Street was expecting. So McDonald's still struggling with a weakened consumer. It's the second straight quarter the company's same-store sales have fallen. While we anticipated a challenging environment in 2024, our performance this year has fallen short of our expectations, said the CEO. U.S. same-store sales rose 0.3%, reversing last quarter's same-store sales declines, but still slightly weaker than the 0.5 increase predicted by street account estimates. So U.S. same-store sales was on the rise, but the global same-store sales were down. And here's why. We'll get into that a bit later. Traffic to the US restaurants was slightly negative, but the company credited its marketing and a $5 value meal launched in late June for the increases in sales. Now, here's the pain points. The two international divisions both reported steeper declines in the same-store sales compared with the prior quarter. Now, the international operated market segment, which includes France, Germany, and Australia, saw the same-store sales shrink 2.1%. The international developmental licensed markets saw sales declines of 3.5%. Those markets include the Middle East and China. So that's the fact of the matter, guys. So McDonald's struggling right now. The US consumer and Canada appear to be doing okay. They've won back a lot of business with promotions, but still consumers choosing to be very, very picky on what they spend their money on. Internationally, however, the brand is still battling with weakened markets in Europe and also across the Middle East and China. So the macroeconomic environment right now, guys, is not the easiest for McDonald's, which is why if I am to bid this company, and I have no problem going into McDonald's, guys, usually they are a bit more resilient than other companies and even more resilient than other quick service restaurant brands in the face of an economic downturn, right? But they will be affected. So if I am to bid this company, I need a very good price for taking that short-term risk, even though in the long term, guys, you can't really beat a company like McDonald's, right? This is maybe one of only two, drink and or food related brands that I would ever hold in my portfolio. McDonald's is one and Coca-Cola is the other. I think they have the strongest business models out there. They have the highest net margins out of any food and beverage brands that you can possibly find, partially because of the way that they run their business models. So those are the two ones that I would ever touch. So in the event we have continued dips on McDonald's, I will be a buyer, but I'll tell you guys where. Looking at the valuation, at $293 right now, their PE ratio is a little bit high, 24.8. They're only growing revenue at 5.3 per year and growing EPS at about 7.6% per year. A little bit slow, but then again, it is McDonald's, right? We're not expecting double-digit growth on both of these fronts. As a matter of fact, if we take a look at their forecasts here, you can see that EPS growth kind of streamlined, right? They have a little bit of an oopsies during the pandemic year. That is completely logical. And 2024 EPS coming back a little bit because it remains a challenging year for McDonald's as they navigate the weakened consumer landscape. They've always found a way to kind of increase revenue though slightly, which goes to show that they do still have a very large customer base and they do still have a little bit of pricing power, even though right now the pricing power has peaked. The proof of that is that they have to run promotions to get demand back to keep this revenue going up, right? So McDonald's, where do they stand? At $293, they have a 3.26 PEG, but the PEG ratio is not the best, guys, when they're growing EPS under 10% per year, and it's more of a value and defensive name, and it's not a growth name. Well, the PEG ratio is not the best metric per se for valuation. I would tend to go with the free cash flow yield and just a straight PE in relation to historical average. So straight PE in relation to the historical average, as you can see right here, on a forward basis, it's a 24.8. Now, that's a little bit high, admittedly, right? Prior to the pandemic, McDonald's was always trading in the low 20s to high teens. That was a little bit steep for McDonald's. Now, since that time, Wall Street has kind of increased their valuation ever so slightly. And as we stand right now, we're almost at a 25, right? So I wouldn't say the business is too expensive, but I also wouldn't consider the business to be cheap either. It's kind of right in the middle there, which is why we kind of need to get the best deal possible if we're looking to go shopping for McDonald's. And the free cash flow yield at 3.28%, well, I always look for companies between 2.5% to 5%. And usually the defensive, more value-oriented legacy companies, that's usually where you'll always find them, between 2.5% to 5%. 2.5% is on the lower end. That usually only happens when the share price increases a lot faster than free cash flow does. And if we're closer to 5, it means that you're usually on a nice dip and that free cash flow has not been impacted so far. So at 3.28, it's a little bit low. I'd like to see 3.5 or better, but nothing truly wrong with it, right? Now, you guys may remember, I played McDonald's a lot down here. This is where I was writing short puts and buying call options, but now we're significantly higher. But they do still have the long-term trend, right? It's a very nice monthly uptrend. In the event they continue pulling back because of macroeconomic concerns and possibly further E. coli concerns, I think there may be a good buying opportunity, guys. Very, very close by. 280 down to about 272. That's the location that I'm looking for. In the event we drop down there, I'm looking to bid the stock down there. We probably will come into daily oversold conditions at that point. So for call options or for building a little bit of a share position, this is where I'll be looking for myself. The valuation will be marginally better, right? We won't be getting a crazy deal, but I do think it's a good location for some swing trades. A lot of moving averages there on the weekly. The daily 200 EMA is there as well. And on the monthly, I'll remind you, we're just looking for a higher low for possible further trend continuation into 2025. So that is the take on McDonald's. And that wraps up everything for earnings. Hopefully you guys appreciated that. Now, let's move into our technical analysis, shall we? And we will see that not much has changed since we did this one after the Thursday session. We were keeping an eye on two things. Number one, the establishment of the daily downtrend by the bears, still in a daily downtrend. And number two, how we broke this rising wedge, right? So the rising wedge has now broke to the downside. And usually when that happens, especially when it's a 3-month rising wedge, usually you do see at least a couple of weeks of follow through. And we had been expecting this, guys. We had been saying that although 5-6 weeks of rally was nice, eventually we will be getting weekly consolidation. And that's exactly what's happening right now. So we are still in a very nice weekly uptrend, looking for the weekly higher lows. Anything above this guy right here, 539, looking for a weekly higher low for further trend continuation. Support area is coming up fast, guys. Talking about 565 down to about 560. Now, I also want to show you one more chart in relation to the SPY, and that's going to be the percentage of stocks above the 50-day moving average. Now, as you'll see, right, this chart is a daily or weekly, and this is just, as it says, the percentage of stocks above their 50-day moving average. When it gets really, really, really high in the 70 to 80s, usually that's when you see a decent market pullback. If you take a look here, here was the initial pullback here early on in the year. Last time we got a decent little pullback here in recent terms, right, was pretty much the early September dip. We also had the early to late July dip right into the Black Monday from August. So usually when you come up here, you are expecting a little bit of market weakness. And then conversely, when we come down into this area, 36 to 30%, that is usually when you find a good dip buying opportunity. After the Black Friday, in April as well, when the markets got crushed. And here is last fall, right? So usually when we come down here, it's a good buying opportunity. As of right now, it's sitting around 50%. So I'm still on the watch. If we do get some further follow through on the S&P, and it's broad market follow through, right? Everything coming down at the same time, that'll bring those odds down on the 50% of stocks above their 50, and we should be pulling back a little bit more. Suffice to say, though, that the bulls do have a lot of space, but this week should be relatively volatile, guys. And don't forget, have the election, we have Jerome Powell, and we also have a decent amount of earnings, although they're not the craziest earnings, right? We do have some decently sized ones, and a lot of semiconductor plays as well. We got Palantir, we got NXPI down here, which is one of your semiconductor plays. Thereafter, we have Super Micro. A lot of people are going to be looking at that one. MCHP Microchip, another one. And then on Wednesday, we have a couple ones that a lot of people are looking at, right? Celsius, NVO, ARM, Qualcomm, ELF all have earnings. Mercado Libre, which is, you can't see it, but it's right below here. And a lot of other ones as well, right? So not as big as a week as we had last week, but we do still have a ton of companies, which could result in some increased volatility. So we'll keep a close watch on that. Moving into the QQQs. So QQQs, same concept, right? We were on the watch for the loss of this daily move higher and potentially flushing the rising wedge pattern that we had over the last 3 months. And that has since manifested, right? So usually when you get a rising wedge that breaks bearish, you want to look for the retest of the lower end of the channel line. And that's exactly what almost happened on Friday. We didn't get quite up to it, but you guys can understand the overall thesis still remains the same, right? We are still looking at a potential backtest into a further short, which could result in an actual daily downtrend on the QQQs, similar to what we've already gotten on the SPY, right? It's just the QQQ was running a little bit ahead of the SPY. Now we've kind of lost the higher lows, and now we're looking for the lower high into lower low. Support below us remains at 481, all the way down to 474. So I would not be surprised, guys, if this week as well is possibly one of consolidation for the overall markets. Once again, I'll remind you, what are we looking for? Anything above 449, looking for the weekly higher low for possible further trend continuation. And if things get really bad and we flush this zone, 480 down to 475, I think we may find somewhat of a base of support down here. A little bit lower than that, possibly around the 470 level, which would be, if we're looking at this on a weekly standpoint, that would be giving back roughly 50% of the move, right around this 26 EMA. You can see that, the QQQ has tagged the 26 a bunch of times throughout this bull run, but very rarely has it lost it more than for just a few 1 week or two at a time, right? So if things get really bad in the markets in terms of continuation of the sell-off, I think that's probably where we establish a new base of support. The bulls with tons of space still though. Moving into the XLF. So XLF financials still unfortunately in a daily downtrend. If we do get continuation, just rely on this area. 46, guys, it lines up not only your previous resistance, which is now support, right? But the 50-day EMA is also there as well. And you can see that usually the financials bulls have done a pretty good job other than the Black Monday event. They've been doing a good job of at least holding this 50 EMA since the bull run started back last November, right? So they've been doing a good job. I expect that's where they'll probably put an end to the pain. But as of now, short-term bears are in control. And on the weekly, we're just still looking for, guys, you guys know it best, right? Looking for a weekly higher low for further trend continuation. Bulls in full control of this weekly uptrend. So keep an eye at this area of confluence. 46 roughly, the 12 EMA on the weekly should be pulling up too. And you can see also the 12 weekly EMA, the bulls haven't really lost a significant fashion since the rally started last November. Moving into XLV. So XLV also trying to find a local bottom. They have to do it soon, guys, because this is a very, very, very big area of support, right? So prior resistance, newfound support. They tagged the 50 EMA. The 50 EMA as well has not been lost since the rally started last November. So they're playing some good defense, but we know the context, right? It's been a massive daily downtrend this whole time. The new leg of which is this. This is one massive leg to the downside, guys. So now that the daily bounce is underway, how do you know the daily bounce has started? Well, you recapture the hourly uptrend. But as you can see, they've been really battling down here, guys. So in the event that this is all we get, just look at the size of this bounce, guys. The size of the bounce right now is meaningless. Only a 38.2% bounce. If we roll over this hourly trend into Monday as well, we can be expecting the bears to start revisiting these lows or possibly put in even further lows. If that happens, guys, keep a lookout because we're already struggling with the 200-day EMA. Haven't lost a 200 EMA since last November as well. So a lot of things we have not lost since last November. And I'll remind you, the weight of XLV and S&P is important. So the bulls need to start playing defense. Weekly downtrend is underway as well. And what are we looking for on the higher time frames? We are looking for the monthly higher lows. They've been doing a good job of playing defense around the monthly 12 EMA. But I'm here to say, guys, that this is go time for the bulls. If we lose this, you're going to take back too much of the monthly move, and you may just get stuck in somewhat of a tightening range at best, right? So they need to get their butts in gear as of pretty much the next 2 weeks in healthcare. So we'll keep a close watch on that one because healthcare earnings are largely, for the most part, behind us. So curious to see how the sector develops from here. Now let's move into SMH. SMH, even though they were up on Friday, still an inside bar with Thursday's candle, right? Not much more action to be had than that. Right now, we have lost the daily uptrend into a daily downswing, and so we'll be on the watch. If the bulls push a little bit higher, we'll be on the watch, guys. The expectation is lower high and then possibly lower low, right? Now, depending how they react to this support zone, of course, they can V-shape, but there is overhead resistance, 260 down to about 250. So if ever we do have something like this happen over the course of this week and the next week, understand who is in control of the longer time frames. The weekly bulls have the weekly uptrend. We are looking for a weekly higher low, anything above 213, looking for that higher low. And this is the big area of support, guys, talking about 238 down to 231. I'll remind you, the favorite way that I like to play the semiconductor weakness is by writing short puts under the market on my favorite semiconductor names. So I'll be keeping you guys updated with a lot of those plays that I'll be making in the next few weeks of time. Moving into IWM right now, the Russell still struggling, guys. So as of right now, we're on the watch for the daily downtrend. It would be a break of 217.42. Break that, you lose the daily uptrend into daily downtrend, and you just go into extended weekly consolidation. I would not be surprised, guys, if the Russell, especially with the mixed data we've been getting, guys, I wouldn't be surprised if we just stay trapped a bit on the Russell for the foreseeable future. The lower level that we're targeting maybe for entries is going to be 214 to down to 206. I'll see how we react coming into this and also what the macroeconomic data is doing, but that is the level that I would like to build a position on the Russell myself. In terms of overhead resistance, I've said it once, I'll say it again. Breaking the 2020 and 2021 highs, guys, is going to be quite challenging unless we have a clear, no recession, soft landing scenario. And right now, the data is fairly mixed. You must understand that. And now lastly, the Dow Jones. So Dow Jones not looking the worst. They were up on Friday. And the biggest highlight, guys, on the Dow Jones for Friday is after the close, they replaced Intel, which has been in the Dow Jones for over 20 years. They replaced Intel with NVIDIA. So we have a new Dow Jones component. So hopefully that can, help the Dow Jones a little bit more, because Intel has definitely not been helping the Dow Jones, right? So that is the biggest news for them. Now, in terms of the trend, daily downtrend is still underway, right? We're on the watch for a possible lower high. That is with a loss of the hourly. So we got the hourly trend back. In the event we lose it as soon as next week, we can say that the lower high is set and possibly looking for the lower lows. So daily downtrend underway. If we get the lower low flush, just keep in mind where we could possibly be heading, guys. 41,003 down to about 41,000 is the likely area. Who's in control here? Well, it's the longer term bulls looking for the weekly higher low for possible further trend continuation. So I'd be targeting this, right? 41.3 down to 41,000. That'll be tagging the 26 EMA. And as you can see, since the bull run started last December, November, we have not really lost the 26 on the Dow Jones. So if we do have another red week, and maybe in the next 2 weeks are red, I'm expecting this to be kind of a final area where you might see a little bit more of support from the bulls. That's pretty much everything for our indexes, guys. Now, let's dive into our big tech names, shall we? And before we do that, give me a very brief moment. And let's get into some action. So Apple down after the earnings, 1.33%. Daily downtrend clearly underway for Apple right now. In the event that we continue our move to the downside, well, first things first, let me just change this box because I didn't do it. So this used to be an area of support, and now, unfortunately, it will be back to resistance. So overhead resistance is still 225 to 230. In the event we back test it again, as we done on the Friday session, you can see the bulls did not like this area. They got rejected instantly. If we continue the plunge, we're coming into an area of support, 219 down to about 215, guys. And in the event we break through this one too, with maybe 1-2 weeks of extra weakness, I will be looking to play some Apple only down here, guys, around the 210 all the way down to about $200 mark. That's where I think the valuation is a bit more fair, and that will once again be for a little bit of monthly consolidation, right? Apple had a great 4 or 5 months worth of rally, but eventually after that, you can see sometimes what happens, right? Apple has to pull back for a few months and then maybe even move sideways. So I'm looking for these monthly higher lows, and I will be interested 210 down to about 200, as close as possible to 200 as I can get. We went through their earnings, guys, and I told you guys on Thursday, the valuation is relatively high, and we do still have some revenue growth concerns, right? So all that being said, I am still fairly bullish on Apple. I'm less bullish than I once was just because of the valuation and the revenue concerns, but I do still like the company. However, if I am to play Apple in a bullish fashion, I need to get the best price possible, which for me is as close as possible to that $200 mark. So we'll keep a very close eye on Apple's price action over the next few weeks. One thing's for sure, though, we have lost the weekly uptrend too, right? So unfortunately, weekly uptrend has been lost. So if you go into a little bit of weekly consolidation here for the next few weeks, once again, 210 out of 200 is my desired buying location. Moving into AMD. So AMD continuing their slide after earnings. Very unfortunate. The company since the pre-earnings is down to almost 15%, guys. AMD just can't get it done, to be honest with you. And, they haven't really moved. We're literally back to the prices that we got early on in the year. As a matter of fact, AMD, I think, is down year to date. Yeah, down 1.68% year to date. So they had a lot of things going for them leading into earnings. We had a beautiful weekly uptrend. We were looking for the higher low, looking for the expansion, and unfortunately, the market just not give it to us. So where do we stand right now? Well, the daily bears are in full control, and we are still, even after a 15% drop, just because of this rally, guys, it brought up the RSI. and now we are not even daily oversold. But we're coming into a nice area though, 142 down to about 128, big area of support that's acted as such prior times in the year so far. Right? You can see a few key areas right here. So this is the area that I do think that the AMD bulls should be able to build a little bit more support. However, guys, we have lost all the momentum on the weekly, right? All of the momentum. This is a too severe pullback, in my opinion, to get the V shape, right? So they've pulled back 80%. The best case scenario for the bulls right now is establishing somewhat of a tightening range and then going for the weekly uptrend reversal, but it's going to take some time, guys. Usually on the weekly, when you sacrifice all this momentum, it does take a while to get it back. Also keep in mind that above us, this big area of resistance is not going away. 162 down to about 153, such a highly congested and contested area for the stock all throughout the year. So I would be confident in saying that if we make our way back up into there, guys, we may get rejected, and it takes a long time for the bulls to set back up a new daily uptrend. But my favorite way of playing this stock down here, guys, is going to be looking for some weekly short puts, right? We know that AMD has some good volatility, so I'll be looking to write short puts under the market. Think the low 130s or the high 120s. That is where I would not mind picking up more shares, and I'll be using short puts to do that. Now moving into Amazon coming in 6.2%, looking very good. But we hit the Jeff Bezos sell wall again. On Friday, it was released that Jeff Bezos sold about $3.8 billion worth of shares. However, he sold them prior to earnings. So this was not him, but the 200 psychological level, guys, remains a very contested zone for Amazon, to say the least. That being said, beautiful daily uptrend right now. So at this point, if we do get a little bit of a pullback on Amazon, anything above 185, looking for a daily higher low for a possible second attempt at smashing through the 200. I will be looking to play this one, guys. If we get a pullback, we're going to be looking at this zone, which I will gladly turn green because now we're above it, right? It was a very hotly contested area of resistance all throughout the year. You can see the number of times that Amazon kind of touched this area without breaking through. Now we are significantly above it, so I'll be looking to use it as support. If we pull down, I will not mind writing some short puts in the high 180s. If we come down here, maybe even throwing some leap call options at it as well, because I think Amazon 2025 and even 2026 should be having some extremely good years, especially in terms of expanding margins and free cash flows. If you haven't seen my earnings that I did on the stock, guys, highly recommend that. It'll give you a better idea of what Amazon's trying to do with the business and why I am so bullish, even super close to the all-time highs. The valuation is quite nice. Moving into Google right now. So Google down about 0.02%. Not the worst time for Google, but they did definitely give back all of their earnings, filling the earnings gap right away, which is a good thing, right? We knew that usually all gaps do get filled, so the faster they can fill it is the better, in my opinion. Now, daily uptrend is still nice, looking for a higher low, anything above 163, still looking for that higher low, but it's about time that the bulls get their butts in gear, right? How do you know the downswing is finished? Need to get the hourly uptrend back. That is the only point that you'll understand the higher lows are set and the bulls may be looking to go for a little bit more. Now, in the event we keep pulling back and give the entire earnings move back, is that such a bad thing, guys? Not really, in my opinion, guys, because the valuation is quite good. We did the valuation at 180 after earnings. It was only a 1.33 peg. So right now at 172, it is even cheaper. And that's what I'm going for my long-term valuation on Google, guys. I think Google is going to be a $200 stock in 2025. A lot of the analyst estimates are significantly above the current stock price, even with their earnings. Look at this, right? Average is about 210, and everybody is either a strong buy or a buy. Some people are holding. You can see fantastic EPS growth rate for the next 4 years, fantastic revenue run rate in terms of growth as well. So Google, a bit of a no-brainer for me. I will continue to write some short puts in this area. And if for whatever reason we come back down into the 160s, I'll probably be throwing another leap call at this one because you guys know I picked the absolute bottom with my leaps the first time. I'll be looking to add a little bit more here. That's everything for Google. Now moving into Meta. So Meta down about 0.07% on the Friday session. Now, Meta is in a bit of a peculiar situation, right? We had a daily downtrend. We got a big move up in terms of the pre-earnings run up, and now they gave it all back. The clearest time frame for Meta, in my opinion, guys, is the weekly, right? We have a beautiful weekly uptrend, looking for the weekly higher lows for possible further trend continuation. If you didn't see my Meta earnings, you can go back in terms of last week's video and look at the earnings. They were fantastic for the company. I've always maintained that if we do get a back test down here, coming into 540 to 530, right? The prior all-time highs here, it is a nice breakout, retest, and possibly run trade. So I'll be sitting right here, guys, in terms of some call debit spreads, maybe even some longer dated call options, because I really want to keep riding Meta. The fundamentals for Meta are absolutely amazing. Crazy net profit margins, crazy free cash flow. Look at this EPS expansion, revenue expansion as well. I would not be surprised if midway through 2025 that this stock is probably trading in the $650 range. So that's everything for Meta. I'm looking for down here specifically. Now moving into Microsoft. Microsoft also not performing the worst, right? Up about 0.99%, but they kind of did not have the best turning out after earnings. They tried to get a lot of it back on the Friday session, right? Nice little pop in the morning, but they rolled over a lot of those gains. So Microsoft still struggling right now. Unfortunately, we did lose all the daily uptrend structure, and we still cannot get above this elusive 420 to 430 area of resistance. So as of right now, we're trading below the 200 daily moving average. The bears are in short-term control. We are not yet daily oversold, but if we move a little bit lower into next week, we probably will be approaching daily oversold. And usually when you find Microsoft close to daily oversold, guys, right? Usually it always represents a decent little buying opportunity, especially when we're close to the 200 daily moving average, right? Every time in the context of an overall bull market, you can see that buying Microsoft around the 200-day EMA is usually a decent buying proposition. So I will be doing the same. If we come back down here, 405 down to about 390, the last line of defense for the bulls for the entire year so far, I will be looking to not only play some short puts aggressively, but also look to pick up more leap call options. I have one leap call option that we bought here, so I'm slightly down on that one right now. Down here, as I was saying on the channel, this will be my average in, and then we just let them ride, guys. 1.5 year leaps. I would not be surprised if Microsoft is trading around close to or above $500 at the midpoint of 2025. So looking juicy here for some upside gains in my humble opinion. Moving on to Netflix. Netflix doing a whole lot of nothing. It was not affected by last week's negativity in big tech. They had fantastic earnings, and the bulls are looking to protect that. So as of now, tightening range. The bulls still do control this. Obviously, if we get a break up here of 773, daily uptrend continues, and we're on our way to the 800 psychological area of resistance. But break this area to the downside, 745, daily downtrend is underway, and you can expect a little bit more weekly consolidation. But who's in control here? The weekly bulls never lost control. Beautiful weekly uptrend, looking for the weekly higher lows for possible further trend continuation. So I'd be targeting 730 down to about 700. This little pocket right here for some possible swing trades, right? Going for the breakout, retest, and possibly run. So I'll be looking for it down there if I do get a trade opportunity. Moving into NVIDIA right now. So NVIDIA also up on the day on Friday, but not able to kind of eclipse the losses of the Thursday session. That being said, daily downtrend on NVIDIA is underway. We are still on the watch. If this does continue, we're coming into a nice area of support. 130 down to about 126 is going to be the area that I'm closely watching how the bulls react to it. Daily downtrend means that we are also in weekly consolidation, and this is the chart that really does it justice, right? In the event we fall through 130 to 126, I do believe the larger area of support where the bulls will play better defense is going to be 120 down to about 115, right? So nice weekly uptrend. We'll see how they react at 130 to 126. If we come down here, 119 to 115, this is where I'm going to be looking to play NVIDIA a lot more aggressively, especially leading into their earnings, which is roughly in 2.5 weeks worth of time. We got some very good information on NVIDIA this past week, and I'm not talking about the Dow Jones inclusion. We got that all of big tech is spending heavily on AI infrastructures, especially on NVIDIA graphics cards, and they said they'll be doing that through 2025. They telegraphed the fact that NVIDIA should have very good earnings, not only this quarter, but possibly for many quarters to come throughout the next year, because that big tech spending, if anything, is staying either equal or accelerating. So expect some decent earnings from NVIDIA on that front. Moving into Tesla right now, Tesla continuing their post-earnings slide, but that's okay. They have a lot of room, right? Now, we got rejected at the classic 265, 270 location. It's been problematic for the stock a few times over the course of this year, and this time was no different, right? Looking for a daily higher low for possible second attempt right here, but more like a seventh attempt over the last year and a half. So the area of support we're looking for is 240 to 235. The bulls acted as defense right here, looking for that to be a slight area of defense as well. So looking curious, if you want to know when the daily move down is done, you need to get the hourly trend back. You can see no hourly uptrend. They tried here for a little bit, and got undone just as soon. Actually, this is with extended hours. If you actually put it on regular trading hours, you'll see no confirmed hourly uptrend. You need to see a confirmed hourly uptrend, guys. That is the one thing that'll tell you that your daily move down is finished and we're looking for the potential rally, right? Now, that's on the daily. In terms of the weekly is also not looking too bad. We do still have the weekly uptrend for the Tesla bulls. And at this point, anything above 211, looking for a weekly higher low for further trend continuation. So I'll keep a close eye on how we react to the 240, 230 zone in the event we get down there. Now, moving on to Palantir. Palantir with earnings on the Monday session after the close, right? Big day for Palantir on Monday. We know they've been down recently. Can they protect the massive gains? Just keep an eye, guys. Keep in mind that since the day of last earnings, this stock is up 74%, came up all the way as close to 86% in a single quarter, guys, right? And I'm taking it from the top of earnings. If we measured it from the bottom of the Black Monday earnings, right? The stock was up over 110% almost. So, you know, you kind of have to taper your expectations. If Palantir's numbers are good, but not excessively amazing, like they don't raise guidance by a crazy amount that Wall Street wasn't expecting, I am expecting this stock to have the Meta, the Microsoft treatment as well. Maybe they report very good numbers, but just because of the excessive gains that we've had, maybe Wall Street justifies a drop in the stock price. Now, keeping that in mind, it'll be impossible to tell what it's going to do on the Monday session, right? All we can do is go through the expected move. And let me give you guys the expected move. So let me look down here. So the expected move for Palantir is going to be about, let's have a look here, 12.4% up or down. So 12% up or down would put us back roughly at the highs that we just had, right? 12% to the upside, new all-time high, 47. 12% to the downside, however, is going to send us down into the whole 36 area. Now that is the area that I'd like to play, guys. So in the event we come down there, what are we looking for? And as a whole, we're looking for a weekly higher low, right? We know we've been consolidating for the last couple of weeks. If earnings make us have a drop and we come back down here, 37, 36, I'll be looking forward to writing some short puts, 34, 33 to farm some premium at a more decent valuation for Palantir, in my humble opinion. And of course, if it rises after earnings all the way up to 47, unfortunately, I will not be able to chase, but your weekly bulls will just retain their control and be due for another weekly leg higher, right? So earnings, always a gamble. I am personally playing it before earnings. I'll show you guys the position, but as a whole, I'm going to be waiting till after earnings for a drop to make a more heavier bet on the continuation of the stock through 2025, right? Just very, very tough for me to chase it up here for now. And that is everything for our stock market analysis and our earnings. Now let's take a look at the portfolio and the trades made from last week. All right, so talking about portfolio now, guys, this is going to be a heck of a review. So pay attention. If you need to watch it twice, definitely watch it twice. Here are all the weekly trade recaps that we made this week. As you can see, a bunch, well, not a bunch, but a few wheel trades, a lot of directional trades that we closed as well, and a ton of earnings trades. You'll remember the last time I gave you guys an update was on the Tuesday session. You've seen most of these trades. You saw the TSM trades, the BITX trades as well that we closed, one of which expired worthless on the Friday session, but we also had a 2-week put that we closed for about 45% profits in terms of a short put. Now, two of the positions that you will not see in this portfolio anymore are ones that I was talking about potentially closing. Number one is OXY. You might remember that we got assigned these a few weeks ago at this point on September the 6th, and also the TLT shares that I got assigned on September 18th. I closed both of those at a loss. You can see the OXY was closed at a 6% loss, and the TLTs were closed at a 7% loss. Let's go through the logic as to why I closed those guys, and you'll see that it's all about capital management and capital optimization. They just weren't moving fast enough, but there's a few reasons as well. So the OXYs, the reason I closed them, the trade is taking too long to recover. The ROI per day is not optimized anymore at all. Been holding for almost 2 months with no movement. I will revisit in the winter months because oil is out of favor seasonally. The fall period for oil is very weak. We also have a temporary de-escalation of the Middle East tensions, and we have a global oversupply of oil. So all catalysts that lead me to believe that Oxy is potentially due for maybe even another leg down. If you take a look at the monthly, how we closed the monthly, back breaking through huge 2 years of support, back testing as resistance and possibly moving lower, which is why I say I will revisit this trade if we drop to lower, more advantageous levels. But for now on OXY, I am out. I am still maintaining a OXY call that you guys have seen in the portfolio for a while. We closed one of these when OXY popped all the way back here. You might remember we made couple $100 on those calls. So that call option offset the loss that we took on OXY right there. I still do have one call option here, which is going to be for a March expiry. So we still have a lot of time on those. We'll see how those goes. The second one that we closed is TLT. We got assigned at $99 after credits received and dividends as well. We got an average cost of $97.15, but we closed them on the Wednesday session, guys, for $91.18 for a 7% loss. Here is why. So, unclear narrative, the US debt levels, the higher rates for longer, the reinflation trade, sticky inflation, and bond trader speculation. It's a very complex trade. It was taking about $9,000 in buying power, guys, and I'd rather just take that buying power and put it towards stocks that are moving more favorably or possibly some earnings trades as well, right? We've been in this one for a month. ROI per day is severely underperforming, and I said there's tons of earnings plays this week on companies that I have higher conviction in than chasing an uncertain bond trade. And I also labeled, yes, it is daily oversold right now, but we could just bounce and stay at these lower levels for some time. Talking about TLT, right? We are significantly oversold right now. We're daily oversold, but guys, I'm not in the business of predicting where the 20-year yields will stop. It's a very, very, very complex trade. You can see we've broken above the trend line right here. We've broken through this area of resistance. So for those reasons, guys, I'm out. There's so many other opportunities that I can play last week and this week as well. And as you'll see from lower, when I give you guys the earnings plays, we made all the money back that we lost on the OXYs and TLTs that we've been holding. I rotated out of them because they weren't moving. And with all the weekly earnings that we played, guys, we made all of the money back, or almost, right? Look at these earnings trades down here. We had about $514 worth of profit. So even though we lost, together with these two, we lost about, let's call it about $900. We made more than half of that back in one single week, which is why I say it's just optimizing capital, right? If plays are running away, there's no sense in maintaining the loss until it comes back, guys. That is just loss aversion bias. You take the loss if you have distinct reasons for it. You cut the loss, you take the capital, and you allocate it to trades that are in more favorable narratives right now. The TLT narrative is out of favor. The oil narrative is out of favor. So why would we stay into them if they have not proven to us that they have set actual bottoms just yet, recaptured the weekly uptrends, and also recapture the daily uptrends as well, right? No sense staying in those trades. That's why I cut them. Now, in terms of the directional trades that you guys did not see me close, MO, you guys may remember, we had some call options that we bought on MO last week, not the week that just had, the week before that, we bought options on MO. I'll show you where. We bought them back here, right? All the way back here prior to their earnings, because Philip Morris, the other tobacco company, they had substantially good earnings, which showed that there's a lot of demand for the sector right now. So I thought, you know what? If they had great earnings, I'll take the gamble right here. Not only was it a good area, but we were also coming into an area that a trade that I like a lot, right? We had the monthly breakout retest, and we were retesting the slight range back here. You can see, right? Broke out, coming down into it right before earnings. I said, you know what? Let's take a chance right here. We did very well on those MO calls. As you can see, we had the $45 strike, March 2025, 570 to 810. 42% ROI in a single week, looking very good. CrowdStrike, we closed the shares. You guys might remember this one. We had it for a while, right? We got CrowdStrike all the way back here. So I'll remind you where. And this one was a weekly continuation pattern trade, right? Nice weekly uptrend. We got some CrowdStrike here around the 285 for the next leg up. We had debit spreads as well. I closed the debit spreads, but I kept the shares. And then when we had good earnings opportunities, I closed the shares just last week, not at a tremendous profit, guys. I admittedly, we closed them pretty much right about there, right? So we took a little bit of profit, not that much, only 3.5% on the shares. Most of the money was made on the debit spreads. I closed this one, guys, because I'm just concentrating the portfolio. You'll see a lot of these closes, I'm concentrating the portfolio right now. Why? Because I've been waiting for these discounts on big tech to throw leap call contracts and write short puts on big tech, which is something that I'll be doing a lot of moving forward. So all of big tech, including NVIDIA and TSM, I'm going with the market outperformers and the market leaders right now, and I'm cutting everything else that is not performing the way I want it to. We are going for a concentrated bet in the highest conviction and the highest quality stocks, in my opinion. So that's what we're doing. You may remember I was telling you guys, I'm going to slim down. I had so many trades running. I was showing you guys a bunch of small account strategies over the last 3 months, but I told you guys, as soon as I have some ideas, some trade opportunities come up in my highest conviction names, I'm going to cut down on the amount of positions and go with fewer but larger size trades. So it's been very fun showing you guys the smaller account strategies, the call debit spreads, the put credit spreads, stuff like that, right? But now I'm getting back to the basics, the stuff that you guys have seen from me back last year in 2023 and early through 2024, when I was taking very few but large size short put wheel trades, but also some very decently sized call options with 6, 12, 18 months worth of time on them. So we're concentrating the portfolio because in times of market uncertainty, we go for the highest conviction, highest concentration bets, and we're probably going to make a decent amount of money in the process. So that's everything for crowd. You also might remember I had a Twilio leap call option. We had the 95 strikes for January 2027. We got them at 920, guys. We closed them at 1586. That was 72% ROI in less than a month. Twilio, we got them. This was an AI play, right? So Twilio is kind of leading the market in terms of voice AI assistance. They have a partnership with OpenAI. We bought the leaps roughly, somewhat back here, right? And then after their earnings, on the day of earnings, they had a tremendous earnings, showed that there's a lot of demand for their products, which was my thesis. And as a result, I closed them. Why did I close them? Even though they were 2-year leaps, guys, once again, concentrating into my highest quality, highest conviction bets. I do think that Twilio will be able to kind of rise here, but if we have some market weakness over the next 2 weeks, I'd rather take that money and throw it towards an Amazon leap or throw it towards a Microsoft leap or towards a Google leap, right? Even though Twilio was a good thesis and the trade worked out perfectly, it's not my highest conviction one, right? All about concentration moving forward. So that's everything for Twilio. Tremendous win there. And the EVVTY as well. You might remember I had EVVTY remaining shares. We closed half of the position about a week ago. We got the shares down here prior to earnings. We had a big pop. We closed half the position here. And then on the Thursday session, I said, you know what? We gave back most of the move. I'm going to close the rest of this position. It wasn't that large, but once again, just cutting everything, guys, that aren't my highest conviction plays and concentrating the portfolio. So that's why we're just trimming the fat on those. The second half, only a 2%, 2.8% ROI, but still green, right? We closed most of the position all the way up here. So I'm not too mad about closing the rest down here, even though we did give back a lot of the gains, guys. I'm not going to wait 2-3 more weeks for them to come back up type of thing, right? I'm just going to focus on Microsoft, focus on Amazon, focus on Google, focus on NVIDIA moving forward, right? Now, that's pretty much everything for those. We did take a few losses as well. ASML, you might remember I bought the dip on ASML, but ASML, even though they did rally, I did not take profit. We bought them after earnings down here. The shares, they came up nicely, and now we kind of gave it all back. So it broke through my area. As soon as Thursday session opened, I closed them at a loss. I didn't want to round trip round trip some gains into a loss. So I just closed the position. Stop loss was at break even. I closed them slightly below break even. As you can see, we took roughly a 2.7% loss on the shares, but I do have one debit spread that I'm keeping. It is for January. We'll see how those go. It's down a lot of money right now, but ASML is just not moving the way that I want it to. So when this one is out of favor, I have this one in my long-term portfolio, guys. I do think that it is in a bottoming out process, but I'm going to focus on the ones that the market is loving right now. That is TSM. They are still in a nice weekly uptrend. That is NVIDIA. They're still in a nice weekly uptrend, right? So I'm going to focus on the names that are in favor in their respective sectors, the industry leaders. At ASML, although it's a very solid company, it has lost the monthly uptrend. It's lost the weekly uptrend as well. So I don't think it has the best chance at having some good momentum. So I cut the position, guys. Once again, concentrating to the highest conviction plays, right? Intuit as well. We cut the shares. We still have a debit spread on Intuit. As you can see right here, we've had this one for a long time, guys. Intuit, we have a call debit spread here. We are up on the debit spread, but I cut the shares. That was about $4,000 in buying power. I said, you know what? I'll take that $4,000 and possibly look for a leap on Microsoft or something like that. So we cut it at a loss last Thursday. 2% down on the position. Not that big of a loss at all, right, guys? I'll keep the debit spread for as long as I can, but once again, just freeing up all the possible buying power, concentrating the positions. And here are the earnings trades. So that's everything. We did a lot of portfolio rebalancing as a whole, concentration, highest conviction names, and heavier position sizes, right? Now for the earnings trades, you might remember my earnings strategy. What is my earnings strategy? It is selling puts 2 times below the expected move. So if Palantir is a move, expected move of 12.5%, I'm looking to write puts 20% or more down below. It's a, usually it's a high probability trade, but sometimes you can still get assigned. So the focus is on high quality names, and we're giving ourselves a wide margin of error. As you can see, all of the ones we did last week, some of them you saw, such as the ones early on in the week, like Visa, Google, and PayPal, AMD as well, CMG you guys probably saw too, but a lot of the other ones you guys didn't see. You guys did not see me take the Microsofts. Microsoft, we were actually underwater on these into the Friday session, but when Microsoft popped to 415, 414, above our 412, we were able to get out as well. So all in all, guys, total profits realized were about $514 for all of my earnings trades. So not only did we crush a few leap calls right here with some decent profits, with some decent profits too. We crushed the leap on Twilio. We crushed the short-term call option on MO. We got some decent wheel trades intra-week. They all offset, right? All these earnings trades, the gains from the leaps, they offset largely. We made a ton more money than we lost over the course of the week. So that's the focus here, guys. The wins, we're getting big wins, and the losses that we take are very, very small. As a matter of fact, the only losses we took last week, playing all of these earnings, you can see them right here, right? All of these earnings, we took a tiny loss on Robinhood of $11. We literally only lost $11 playing such a volatile stock like Robinhood. Additionally, we took a tiny loss on SOFI. How tiny? A $3 loss playing in volatile earnings event. The rest were all very, very, very healthy wins. So it's been a very good week overall. That is the recap for the entire portfolio. Now I'll show you guys what I still have, and we're going to go through these a bit quickly, right? AMD, February, 170 to 175, bull call debit spread. We took these before earnings. It did not play out. This was a speculative gamble on earnings. I have a lot of time left on these contracts. I will continue farming premium on AMD with some short puts down below here, but not yet adding to the call debit spread. I need to see an uptrend before I consider adding to any calls or any call debit spreads. There's a lot of time left on these, so hopefully they come back. But as of right now, we are down on the position. The moral of the story is do not risk anything more than you're willing to lose. I was willing to lose a good portion of 3 contracts. We're down on those right now. What do we have as well on AMD? A new position here, a short put, the 135 short puts, 2 weeks worth of time, right? The calculation is as follows. 204 divided by 135. We're getting about 1.5% for 2 weeks on those AMD contracts. I like writing AMD down here, 135. We'll see if we get assigned or not in this lower location, but I like the weekly ROI. I'm usually looking for about 0.5% per week, so that is well above 0.5% per week. ASML, you guys should know this one already. We are still keeping the bull call debit spreads. We're down, 66% on these. I'm holding these. This is my play on an ASML quick recovery. We'll see if we lose all the money on these. Perfect. I'm never risk more than I'm willing to lose, guys. ASML, though, out of favor right now. BITX, we have another put for this week as well, $29 puts. That puts Bitcoin roughly back at about 65, 64,000. If we come back down to Bitcoin there, I like Bitcoin right now. It's in a nice weekly, daily and weekly uptrend, right? But if we come back down and test 65, 64, I will be a buyer, guys. I love the monthly close on Bitcoin. If we get a little bit further weakness and pulls us back down here again for another weekly higher low, for another attempt up here, I'll be picking up some BITX. And if not, if we stay above 29, I collect $1. Look at the ROI on this, guys. I've been playing BITX for a number of weeks now with good success. 105 divided by 29, that is 3.6% in a single week, with about a 10-12% margin of error to the downside, looking quite good there. BRK, we're building a position on Berkshire. I've been telling you guys, I like this stock a lot. They just said their earnings. We'll go through their earnings on the Monday video. Looking to build a position in this lower range, guys, looking for the eventual breakout of the range by Berkshire. So building a small position, but still, we do have a position right now. 2 call debit spreads for January, so a lot of time left on those as well. Disney's, this is a longer term recovery play. Google as well. I wrote the 167.5 puts for $1.29 on the Friday session at the lows of the day. Now, once again, Google, I'm looking if we come back down here into the 167.5, 165, looking to write a lot of puts there, be aggressive with it. We're already up on this contract, looking good. Still have the Google Leap contract. I'll be looking to add to these if we come back into the mid 160 zone. Intel is a long-term leap position, 2 years worth of time almost on this contract right here. They're up nicely after their earnings. I'll be looking to hold these for a recovery story for Intel. Intuit, we went over it already. Microsoft, these are a ton of debit spreads. One that's not here is the leap call option I have on Microsoft. It's in my different larger trading account. So the Discord members know it. I actually took the trade right here, but if you guys want proof, I'll show it to you right now. The long-term Microsoft Leap is right here. You can see we took it 10/16, so October 16th, and we got them for about $98.45, so about $9,800. These are the June 18th, 2026, $360 calls, roughly a 80 delta play. So we have that. We also have the debit spreads, which are currently underwater right now. We have a lot of time. We have one for the December, 435, 440 strikes, and one for February, same strikes, but a lot of time left on these. We're not down too much. We bought them recently, so we'll see how Microsoft goes, but I'll be looking to build a heavier position on these if we drop lower 400s. Then we have the Micron asymmetric leap call bets. We'll see if Micron benefits from a semiconductor rally. We round tripped a lot of these gains, guys. I could have closed these right after earnings, right? After earnings was a big pop. We were up like 200% on these calls. They've come down in significant ways. But if semiconductors have the rally that I'm expecting for them in the next 3 to 4 months, and we come back, I'll be looking to close these probably Micron 120, 130. So we'll keep an eye on those. NVIDIA, 120 puts, 2.5 weeks away. The week of earnings, we got $3.24. So I told you guys, I want NVIDIA in that location, 120, 115. As we just saw in the technical analysis portion, all the way down here, right? So now we got a good margin of error, $3.24, 2.5 weeks of time, 324 divided by 120. You're seeing we're getting about 2.5% ROI, which is well above our 0.5% weekly minimums. NVO bull call debit spreads, these are pretty much entirely worthless. They have earnings this week. We'll see if we can get a little bit back on these. This was just a trade that I let run for way too long. Admittedly, it's one of the only not properly managed losses that you guys have seen me possibly take on the channel in the last year of trading, right? I got a little bit too ambitious with this one. I held it for way too long. I was thinking that NVO would get a quicker recovery than they did, thinking that they were going to react from this zone. And as soon as they broke through this zone, I got too stubborn with it. I said, you know what? I'm holding through earnings, worthless or not. And as you can see, well, now they are worthless. So mismanaged position by me. Happens to the best of us, guys, but thankfully my sizing was okay. We're only down about $500, not that large in the grand scheme of things when I'm running $100,000 of exposure, right? Oxy, we talked about these bull call debit spreads we're taking, 2-3 months ago at this point. They were quite ambitious, but I didn't risk too much on them. So we'll probably be just keeping these through expiry, see whatever happens. Palantir, we have an earnings play here, $33 puts for 27 cents. This is like 20+% away on Palantir. If I get assigned at 33, no problem at all. Paying almost 1% for such a wide margin of error. We still have the Square Leaps, which are doing very, very good right now. And we still have a few TLT contracts here as hedges. They're hedges, guys, so it's normal that they're down a lot, right? But we'll see what happens for the rates. Rates took a very unforeseen direction after the rate cuts. So I closed the shares. The exposure is not that large right now, but you can see I'm very transparent with my positions, right? We're down on all of these call options. At least we have January and some June. So we do have some time on these in the event we get bad data and people start bidding bonds back up. But as a whole, guys, these are just some hedge trades that have not performed as we have liked them to, right? So this is the stand. This is the markup of the portfolio. As I said, I'll be concentrating the portfolio a lot more, playing mostly my favorite big tech names because there's a few of them that I like in these valuations, guys. Amazon, I love it back here. I'll be playing it aggressively. Google, I love it back here as well. Meta, freeing up some buying power if we revisit this area right there. Love it. Microsoft as well, and a decent little area down here, 400. I'll be going heavy on this one. NVIDIA on a pullback. I'll be going heavy on this one too if we revisit 120. Palantir as well. Want to free up some capital if they have a bad earnings. I'll be going pretty heavy down here too. So some of my favorite names are giving me some opportunities right now. I'm not saying I won't play other names. There's a few names that I'm looking at right now, like SPGI on a pullback. Wouldn't be opposed to be building more of a position on this one down here. McDonald's as well is a call option potential if we come down here. Another one that I'm interested in. I told you guys I'm building more of a position on Berkshire. in this area down here. And there is one healthcare play I'd be interested in playing if we continue getting healthcare weakness, which is UNH down here, right? So I do still have some ideas, but you've noticed they're very high quality names, right? So I do still have some ideas left on the table. You guys know me, I always have ideas, but for the most part, you'll see a lot of concentration into our big tech names because I think the most favorable trade in the market right now, even into 2025, with market uncertainty or not, I think the easiest trade right now is Mag 7 just because of the valuations. And in the event the market gets scared because of economic concerns, the money is probably going to focus on Mag 7 as it did earlier on in the year. Think of how we were in March and April. I think it's going to be pretty much the same thing. So, bit of a longer video today, but we can afford it, right? It's a Saturday. You guys have some time. We did a full portfolio recap, which usually takes 15, 20 minutes. We only do them on Friday. So hopefully you guys enjoyed today's video, even though it was long. Thank you very much for watching until the end. If you did enjoy it, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. We do these videos every Monday through Friday after the close, usually. And as usual, guys, if you have any questions at all, feel free to leave them down below in the comment section. I usually always answer in 24 hours. And if you guys want access to all of these trades in real time, as you see, we do some wheel trades, some longer dated wheel trades, shares and call options. There's a bunch of them, a lottery trades for earnings as well, the ideas, the setups, the private market live streams, the private videos, and chat with me all day. Ask me my opinion on your stocks, your options plays, anything you want. Well, the link to the Discord is always down below in the description. So hope to see you in there sometime soon. And if not, I'll see you guys back on the channel. Have a great rest of your weekend. I'll see you tomorrow for the top 5 options plays of the upcoming week. Take care, guys. Been a pleasure as always, and peace.